Today, the bond market made the move, and it made clear that this story isn't really about Nvidia, and it isn't really about Iran. It's about a regime change in interest rates that just broke into territory we haven't seen in nearly 2 decades. On the equity tape, stocks took the hit. The S&P 500 fell 49 points, down 0.67%, closing at 7,353. Its third straight losing session. The Nasdaq dropped 220 points, down 0.84%, to 25,871, with the AI names again under pressure. And the Dow shed 322 points, off 0.65%, ending at 49,364. But the real story today was happening in fixed income. The 10-year Treasury yield pushed to a 16-month high near 4.66%. And the 30-year, the part of the curve the Fed has the least direct control over, spiked to roughly 5.19%. That is the highest the long bond has yielded in nearly 20 years. Bank of America put a number on what the market was already saying. The Fed may not get to cut until the second half of 2027. Not next quarter. Not the end of this year. Next year. Here is what makes today different from yesterday. Yesterday's selling could be pinned on Iran. Today, President Trump publicly postponed a planned Iran strike, and oil actually eased. Both Brent and WTI gave back some of their recent gains. The war premium came out of the trade, and yields kept climbing anyway. That tells you the move is not a geopolitical reflex. The long end of the curve is repricing the entire path of U.S. interest rates, and the only catalysts it needs are the data we already have. Underneath, it wasn't all red. Home Depot reported first-quarter earnings that beat expectations, and shares ticked higher, a small positive signal on the consumer. Micron and SanDisk caught bids against a wider chip sector sell-off. On the other side, Nvidia and AMD slipped, and the rest of the AI complex came along with them, which sets up the moment of the week. Nvidia reports Wednesday after the close. With the long bond at 20-year yield highs and tech leadership wobbling, the AI trade is being asked to carry this market against a rates backdrop that has fundamentally turned. Analysts expect revenue growth somewhere around 80% year over year. Anything less than convincing, and the market has a problem. While everyone's been watching the rate decision, the yield curve just made its decision. We cover the markets on the days that actually move, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.